Well, here we are at the end of the first quarter of 2016, a quarter which featured some dramatic global central bank activity, in particular the ECB, the European Central Bank's announcement of a buffet of new monetary easing options, as well as the Bank of Japan's negative interest rate policy, NIRP initiative. Now, I think in a normal quarter, those two central bank moves would have been the market movers for the quarter, but they were overshadowed by the Federal Reserve, which took a dovish turn during the first quarter, and probably the most important market impact sent the US dollar weaker versus global peers during the quarter. This was highlighted by Janet Yellen's comments in New York City during the final week of the quarter. She was very dovish in terms of her tone, and she also listed a great deal of economic risks to the U.S. outlook due to global economic activity that some investors worried about. Now, we've received some new information since she spoke last week, and we think those help us understand a little bit better what's going on in the world. So first was the jobs report, which came out of the U.S. for the month of March, and we learned two things from that jobs report. Number one, job growth persisted at an average pace of 240,000 per month over the last 6 months. That means, ladies and gentlemen, that fears of a recession early in the quarter were overplayed. The U.S. economy, while having some impact from global weakness, is not slumping into a slower job growth environment. The second really key thing, and much overlooked, I think, in the jobs report, is the labor force participation rate. It's been on the rise now for the last 6 months. That means that the old narrative that the U.S. economy was fragile and people were leaving it, giving up on finding a job, is wrong. Instead, people are streaming back in at record high levels into the job market. So that's driving up the labor force participation rate. 4.5 million people, in fact, moving from out of the labor force to employed in the latest month of data. This is a good sign. Now, this has implications for monetary policy, we think. And we think this is an area where maybe the market is still getting it a little bit wrong. So if the U.S. economy is resilient, not going into a recession, then we think the market narrative that things are weaker out there and the Fed can't hike at all, that narrative is probably wrong. That said, if more people are coming back into the labor force, that means there's a little more quote-unquote slack in the labor force, then Janet Yellen may have a point that she can go slow in terms of rate hikes over the course of 2016 and beyond. Now, the key, though, is going slow is different than not going at all. And I think that's where perhaps the market has it a bit wrong.